Let's start by summarising what we learnt last time. Passive investing has grown steadily in popularity in the United States since the 1970s and continues to do so. Passive already accounts for more than 30% of the institutional investment market in the UK. And increasingly, both financial advisors and independent experts are starting to recommend passive to individual investors. In 1973, an American economist named Burton Malkiel wrote a book that's become a classic. It's called A Random Walk Down Wall Street. Now, although he backed it all up with detailed statistics, charts and studies, his argument is a simple one. You can't predict share prices. If you do manage to beat the market, it'll be more than likely down to luck. Even then, transaction costs will likely cancel out any extra returns you make. As for picking the next star fund manager, you might as well forget it. To quote the author himself, a blindfolded chimpanzee throwing darts at the stock pages could select stocks as well as the experts. In the intervening 30 years, the fund management industry has poured scorn on Malkiel's theory. But no one so far has managed to disprove it. Now in his 70s, very wealthy, Malkiel is more convinced than ever that passive investing is the rational choice for every investor.
Every time I do a new edition, the 10th just came out, I ask myself, is the hypothesis true? Do index funds outperform? And every time I do it, I find that index funds do better than about 2/3 of the actively managed funds. And then, when I look at it in the next period, I find exactly the same thing, and the 1/3 that beat the index in one period aren't the same 1/3 that beat the index in the second period.
In fact, despite there being a wealth of evidence in favour of passive investing, produced by some of the world's most distinguished economists and statisticians, the intellectual case for active investing has been almost non-existent. Active's most vehement supporters are fund managers themselves, i.e. those who earn a very comfortable living from it.
I find, as a generalization, most active money managers have little interest in these debates. If they're involved in a debate at all, they simply point to people who have been successful at managing money and say this is proof that active management works. Well, it isn't proof because doesn't demonstrate that the results are any better than luck, but it's the best they can come up with.
One former active manager who converted to passive says many active managers privately admit that passive makes much more sense.
When I converted over to passive and I started writing about index funds and how my peers are going to have a very difficult time beating the market, and here are the statistics and here are the data, I can't say that I was invited to any more parties. I can't say that I was shunned because I could show up to the parties just because I was part of the group, but I wasn't invited anymore. Now, I will also say, though, that one-on-one with my peers, in a private setting where nobody could hear the conversation, they would readily admit that it was very difficult for them to beat the market and that they personally believed in what I was doing.
And this is what Warren Buffett, the world's most successful active manager, says about passive investing. Most investors, both institutional and individual, will find that the best way to own common stocks is through an index fund that charges minimal fees.
I particularly like the fact with passive investing that you put your money in, and if you're sensible, you don't even think about it more than once a year. That's what I've done, and that's what I recommend to people who don't have the time or the interest to spend a lot of time in front of screens, learning about companies, learning about sectors, reading company reports, etc. I don't have that time, and I'm working in money. I don't have that interest. If you do have the interest, really to spend the amount of time that you need to, the kind of time that Warren Buffett, for example, spends, then sure. But on the whole, for most people who have lives, who have jobs, who have families, Passive investing makes perfect sense. And having mentioned Warren Buffett, he thinks the same. So, hey, can't be that bad, eh?
Of course, the passive approach doesn't guarantee big returns, no matter how long your timescale. But even in turbulent economic times such as these, a balanced, passively managed portfolio, carefully weighted to match your own emotional tolerance of risk, does guarantee something even more valuable than that: peace of mind.
People often ask me, with regards to our clients, do they contact me with worry about what's going on? The answer to that is no, they don't. Because when I say they join a program, our job is to educate. Once they've been on the program for 12 to 18 months, they are probably better armed to actually know more about investment management than probably 60 to 70% of the financial advisors and some of the fund managers.
Now, you may have noticed that we've deliberately avoided singling out specific fund management companies for criticism. As long as you read the small print, you can see for yourself how much each company charges, and it's easy enough to find out whether they really do deliver the returns they say they can. But we did ask the industry regulator, the Financial Services Authority, for an interview. This was its response.
Unfortunately, we will have to decline your request to participate in the programme. The FSA has strict rules about being seen to endorse a particular firm, and that will prevent us from participating.
Indeed, this film has been funded by a company that specialises in passive investing. But given all the advertising for actively managed funds that we're constantly bombarded with, also privately funded of course, using customers' money, you could say it's about time that someone redressed the balance. So you've heard the main reasons why we think the fund management industry is letting investors down, and why a passive investment portfolio is the right solution for the vast majority of investors. But don't just take our word for it. Why not investigate a little further? It won't take long, nor will it cost much, if anything at all. But financially at least, it might just be the best investment you'll ever make.
I think with a lot of investors who go into the passive investing side and go into the indexing side, it's a road of self-discovery. So something sparks them to start looking into it. And once you start looking into it and you read a book and it leads to another website, it leads to another video, and all of a sudden you have like what I had, which is a chemical reaction. And you say, I get it.